Hi, this is Daniel. You're watching Unrivaled Investing. Today we are looking at Social Financial, or SOFI, trading under SOFI stock, recently de-SPACed from IPOE, so one of Chamath Palihapitiya's SPACs, and investors are wondering, hey, could this ramp higher? The stock certainly is up from its low just a few weeks ago where it was trading in the low teens. Now it's in the low 20s, and investors are wondering, hey, what's the update? What's the update on their fundamentals? Is it possible that now that the stock has de-SPACed, the deal has closed, is it possible that there's buyers just that were waiting on the sidelines that now can get in and move it higher? And you've seen that with some SPACs in the past. After the deal goes through, stock just ramps higher, but is it justified? Because sometimes after something ramps up, it collapses right back down. So we're going to talk about the fundamentals of SOFI, what I think about the valuation, and let's dive right in. But first, one should understand this isn't my first video on SOFI. If you want to get a sort of deep, detailed analysis on what is the business based on their first presentation, that's this video. I'll leave a link to it below. And this is not my first video on SOFI in terms of understanding it. And if you just want to cut to the chase of what they're trying to do, their aim is to sort of build this, financial super app for, let's say, above average credits, above average incomes. If you, let's say you recently graduated from law school, or, you're on your path to becoming a doctor and you want to consolidate your student loans, that has historically been their bread and butter of serving those customers well. And then saying, hey, we can roll out more and more functionality like managing your savings, and oh, you might want a home loan, and oh, you're going to want a credit card. So all sorts of different things over time that can get layered in. And the key crux of the thesis is that when you can get multiple products and cross-sell certain products, like, hey, you build a great relationship doing student loans, then you can cross-sell them on a home loan. Then when you cross-sell them, the margins is much higher because you've already acquired them as a customer. That's the big deal. And look, they put up blistering first quarter 21 growth, where they posted a adjusted net revenue growth of 151% year over year. They're certainly better than what I was expecting when I initially did my presentation, and I think better than what they even expected. And this is the part of investing that throws a lot of people off. Like, look, investing is not static. You constantly have to update your thesis. Now, fortunately, it's only 4 times a year that you're getting the fundamentals for the most part, so you can update your thesis when you get this information. In this case, 150% growth is sort of eye-popping when you look at it. And they're continuing to expect really strong growth, and we'll talk about that in a second. But this is what investors love, where they guide to 190 to 195 million in the first quarter 21. They deliver on 216. That's a nice beat. They guide to negative 5 million in EBITDA to 1 million. 4 million, that's a nice beat. This is exactly what investors love. This is what causes stocks to go up a lot of the time, is when you underpromise and over deliver. And that's exactly what they did for the first quarter 2021 financials. And they're still expecting strong growth. Now, it is admittedly quite decelerated from the first quarter, where they're saying 58 to 61% growth in the second quarter. We'll talk about why they might be expecting deceleration in just a minute, and why it might be even more in the future. But still, 58 to 61% is market-leading growth. And that's a key point that it's worth focusing on, is that there's no way the financial industry is growing 50%, 150%. When you see these types of numbers, this is part of a broader thesis that fintech companies are taking share. They're figuring out better mousetraps to get customer attention and service them, provide loans, underwrite loans, using algorithms, figuring out ways to meet customers where they are and get to them and finance them faster and create better relationships longer term. This arguably is an advantage relative to sort of the legacy models of, let's say, Wells Fargo, Bank of America. They haven't really figured out the mousetrap because they have their own advantages over something like SoFi, where they have this really advantageous cost advantage, where they have these low cost, billions and billions of depositors putting money with them, that allows them to say, hey, we get effectively this free money that we're going to lend out in home loans. So they don't have to worry about that customer acquisition for now. That's going to get disrupted, I suspect, with fintech, as you see companies like SoFi sort of move into traditional banking space and start getting more and more depositors. But for now, when you see that type of growth, that should be a green light saying, hey, it's worth listening or learning about this story, because it suggests they're disrupting a model in terms of traditional finance. There's no way financial industry is growing at 50% a year. they are, and there's a reason why, and it's because they're meeting customers where they are, and have a better mousetrap, I'd argue. And so, what's driving this revenue? What drove their first quarter numbers, this revenue growth? This 216 million versus 86 million in revenue in first quarter 20. And the reality is they do have several segments: lending, technology platform, which is primarily their Galileo segment, also financial services. Think about their investing side, their investing apps, that they're trying to build out. One should understand that at this point, the vast majority of their business is tied to lending. So this, and we'll talk about what types of products that is in a second. But when you're thinking about, oh, it's so great, financial services grew by 3x year over year, yeah, it doesn't really move the needle right now because it's 6 million versus 168 million for lending. And the technology platform, this is, I don't like the way they showed this, because Galileo, their key segment, was acquired in May of 2020. So yeah, this isn't really apples to apples. And so you can see its growth rate. I would probably just look at where it was over the last 2 quarters. Yeah, it's up nicely, but it's not the same sort of like, 46 million versus, 1 million a year ago. So it's certainly not as compelling, I would argue, just based on that sort of growth rate. But still, their lending business clearly is up quite significantly from 80 million last year to 168 million. And when you think about their lending business, their key products: student loan refinancing, home loans, private student loans, and personal loans. I mean, this is all providing loans. That's the key crux of it, and that is the vast majority of their revenue at this point. They are looking to grow technology and financial services over time, but lending is the crux of it. And you can see, just going to SOFI, jump to the page, you can see these are the key products that they're targeting. And the challenge, though, and this was a bit of a red flag, it's buried at the end of the presentation for the first quarter results, is that their originations, their loan originations, and keep in mind, loan originations should over time, I'd argue, lead their results. Their loan originations were down quite a bit, and they didn't really call this out in the presentation. You had to look in the in the appendix in the back, where student loan originations were down by 50%. Personal loan originations were also down, and the home loan originations, those were up nicely. And so that might be, like further push into the space. So you got to give them credit there. But broadly speaking, I mean, it was down nearly $1 billion year over year in loan originations. And so it makes me wonder what's going on there, and could this mean that their growth will further decelerate in the years ahead? Now, keep in mind, just this is the rate in which new loans are getting added to their book. So it's not necessarily saying, hey, you're going to dramatic, like that's the reason why their first quarter was able to post such significant growth, despite the fact that their originations were down significantly, is that this, I would argue, is a leading indicator of what their growth rate will look like in the future, just because it's the delta or the change in their lending book. At least that's how I'm thinking of it. It does raise some big questions of like, well, wait a second, why are you seeing this change in originations? Is the personal loan originations, I just did a video on OppFi, and they're sort of calling out, look, the reason why our originations were lower year over year was because people were getting stimulus checks and you didn't need personal loans because you just got your stimmy. Now, the thing with student loans, it's not clear to me, and I'd love to know that piece. If you know, or if you think you know, leave a comment below. I'd definitely love to hear that angle of like, why are student loans down by 50% year over year? Is that COVID and people just, saying, hey, I'm just going to go to a community college or do Zoom school, or what's going on there? That said, despite what I'd argue is a potential red flag with their origination figures, is the fact that they are still reiterating strong, 2021 figures. They're still reiterating their original 2021 figure of 58% growth, 980 million revenue growth, strong contribution profits, strong EBITDA, of 27 million. Now this is important to see, because historically it's been quite unprofitable. So you want to see that the business is starting to get leverage over time, and they're getting that operating leverage and can be profitable in the years ahead. And so I look at this and I start thinking, okay, this is great to see all this, but what about their valuation? And so if I could do a quick plug, if you will, where, as I already mentioned, my name is Daniel. You're watching Unrivaled Investing. If you enjoy these types of breakdowns, looking at these types of stocks, looking for potential multi-baggers, types of stocks that we think can potentially go up hundreds or thousands of percent, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey, first week of each month, I call it my full portfolio. You can see my top holdings, what am I buying, what am I selling. And during the month, I also call out one idea that I think is a potential multi-bagger over time, type of company that I think does have that hundreds or even thousands of percent upside potential over time. I'm looking for asymmetric types of bets, and we're also building an exclusive community that of like-minded investors trying to, think about these types of investments. So exclusive content and building a community of like-minded investors. Let's dive back into SOFI. And so as we're looking at this, looking at their valuation, I look at it and I'm not crazy about it. It's currently, low 20s price, $23 a share. One needs to consider the dilutions that's going to be there. It might even be worse than I'm penciling out, of about nearly 900 million shares. That gets to around $21 billion market cap for this valuation. And let's give a full range of credit to whatever, management's guiding to, where, they were pretty much penciling out 60% growth. And I'm using management's case in the base case, saying, hey, what if they're actually being conservative? And so the base case is actually pretty much in line with what management was guiding to. So I do an implied growth for 2021 of 50 to 70%, which is quite nice. And then long-term optimized margins of 30 to 40%. That is very, I would say, aggressive. I might be being a little too aggressive here to assume that their operating profits long-term can be 30 to 40% when their EBITDA margins today are 3%. So it's that is, I might be giving them too much of a benefit of the doubt there. And so that's why, I'm sharing these assumptions. If you have a different take, I'd definitely love to hear it in the comments below. So then the question is, well, what's their growth rate in the ensuing years? I assume over the ensuing 4 years, because I like to have a long-term framework when I'm looking at investments. So in the ensuing 4 years, I say 25% to, let's say, 40% range of growth. And then what's the end multiple 5 years out? What is this going to be valued at in 2025, end of 2025? And I'm assuming 20 to 35 times earnings multiple for this, for this earnings. That's 5 years out is a long time from now. A lot of things can happen. You can have a lot of competitors enter the fintech space. You can have banks start to get serious about competing. There's a lot of different ways this can shake out. And so, I think it's appropriate to have a range of valuation, 20 to 35 times. And keep in mind, this is a hypothetical framework. Of course, stock prices can go way higher, way lower. But as I look at this range, thinking, hey, 50 to 70% growth this year, 30 to 40% operating profits long term. They're nowhere near that today. Long term, slap on a 25% tax rate. That would mean if they were to optimize their profits this year, which they can't, they won't be doing, then you're at 65 to 98 times earnings, which is on the richer side relative to what the growth is that we're penciling out of, let's say, 50 to 70% growth. So once again, if you think I'm being too conservative and maybe, this should be 60 to 80% or 80 to 100%, I welcome feedback in terms of how if you're a shareholder in SOFI, what you think, the assumptions are or should be. But I look at this and based on these assumptions, 25 to 40% annualized growth in the ensuing years, 20 to 35 times N multiple in 5 years from now, and I get effectively down negative 50% or upside of 100%. And honestly, that framework of a risk or reward just doesn't seem that compelling to me, for this types of investment where, there is this red flag or concern with origination, and it just does seem richly valued. And I think honestly, you can find more attractive plays elsewhere. For example, I have done a video on Alibaba that is a stock, in full disclosure, that I do own, where I think the risk reward strikes me as much more attractive. And in May 2021, for my Unrivaled Investing Journey subscribers, I did call out a stock that's trading below liquidation that I think, has 2 to 3x upside over time. So that type of risk reward strikes me as way more compelling versus something like this where I'm like, I think a lot of people are hyped, like, hey, this thing just de-SPACed and it's one of Chamath's plays, and there's a lot of people that love what Chamath is doing, and the people are pumped about SOFI. Hey, there's a SOFI stadium. I drive by it. That's exciting. And people look at it, and I just think, hey, there's better plays elsewhere. There's better risk reward, and that's what investing always comes down to. Is it's not only about finding these exceptional companies, and that's my goal here with this channel. I want to find the exceptional companies, and SOFI might just be one based on their growth. That is indicating they're doing something special. but you also have to factor in not only what is this value proposition and are you a strong company with what's your valuation. Because you can deliver exceptional results, but if your valuation holds you back, you can have lackluster returns. If this video has been helpful for you, whether or not you're a SOFI shareholder, I appreciate the subscribe and hitting that thumbs up button. Thanks so much for watching.